For a perspective on global and Indian equities, we have Robert Parker, Senior Advisor, Investment Strategy and Research at Credit Suisse, joining us. Robert, good afternoon. Thank you very much for joining us. What do you make of what we've seen in terms of a correction in global equities? Would you put it down mostly to what's gone on with crude and Greece?
Well, you're quite right to say that investors have started 2015 in a very negative or pessimistic mood, and that's clearly highlighted in the market moves we've seen since the beginning of the year. And some of the worst falls are in the European markets, and most notably, over the last 12 months, the Greek market is now down about 35%. Just this year, just the first few trading days of this year, Spain is down over 3%, Germany is down close to 4%, France down over 4%. So we've had a global sell-off, but the sell-off has been most pronounced in Europe, and specifically in Europe, I think we have a number of issues. The first is obviously the political issue. We have the Greek general election on the 25th of January. I think it is likely that Syriza, the left-wing party, will not form a party with a government with an outright majority, but they are likely to get the majority of the vote, and therefore they will probably lead a coalition. But you have extreme uncertainty as to what is the outcome of the Greek general election, and clearly around that there is the debate as to how Greece will now renegotiate further, and this would be the third or fourth renegotiation on its outstanding debt. And clearly Syriza are looking, although they want to stay in the euro, therefore the probability of a Greek exit, I think, remains low. That is worrying investors, that probability. And Syriza would want to renegotiate a further write-down in Greek debt. So that is one negative. Having said that, we also have, in the Eurozone, I think a sustained period of deflation or very weak inflation numbers. And therefore there is investor concern that this year could be a rerun of what we saw in Japan in the 1990s, i.e. a weak economy dominated by deflationary forces. And although logically the fall in the oil price should be very positive for Europe as an oil consumer, I think investors are focusing too much at the moment on deflationary risks. Now, having said that, the contagion effect from Greece on other European markets is currently very low. So Spanish bond yields, 10-year Spanish bond yields, for example, are down at 1.57%. And that's partly due to the recognition that Greece is an isolated problem, also partly due to the fact that we're expecting at the end of January or in February the European Central Bank to come in with quantitative easing through the purchase of government bonds.
Robert, that sort of, prompts the second question, which is how much weightage would you give these Greece concerns? Would you give the concerns regarding crude prices? I get the deflation issue in Europe and how serious that is. But do you think these concerns are just excuses for the markets to sell off, given the kind of gains we've seen last year in some of these markets? Or do you think that they will persist in terms of a negative, emotional sentiment on global equities, especially European equities?
Well, I think let's look at the positive arguments, and one has to emphasise that this fall in energy prices, and just to quantify that, one looks at Brent back in May. Brent was trading at $115 per barrel. Brent is now trading close to $50 per barrel. That is a significant boost to the global economy and for countries which are oil consumers. And obviously one major beneficiary there is India. And that's why, I am very confident, much more confident in my forecast that Indian growth in 2015 will accelerate well above 6%. Likewise, I'm confident, more confident, that Chinese growth will not slow down to 6.5%, and I think China could hold 7% growth. I think if we're going to get some positive surprises, Germany as a oil and energy consumer could easily see growth accelerate to 1.7, possibly even 2% this year. So, yes, there are major structural problems in economies like France and Italy. Greece is a one-off special situation, but let's not forget that most Greek debt is now owned by public institutions such as the European Central Bank and the IMF. And that's why I think the contagion effect from Greece actually will be controlled. We won't see it spill over into a broader Eurozone crisis. One factor, of course, which is positive for everybody is the appreciation of the US dollar. The fact that we've got the euro at 1.19 against the US dollar from a high of 1.39 last year is very positive for European exports. And this fall in emerging currencies, frankly, is not going to do the emerging economies any harm at all. It will, I think, benefit. And the fact that we've had some slight weakness in the Indian rupee with this slippage back to sort of 63, 64 is not a negative for India.
Robert, just hang in there. We'll come back to you in just a bit. We've also got Bhat, MD of DALTON Capital Advisor, joining us. Mr. Bhat, good afternoon, and not a very happy new year, but a happy new year to you anyway. Markets do tend to overshoot on either side, but does the ferocity of today's fall surprise you and concern you?
Absolutely, because even when there are issues about Europe and oil, the countries which are directly affected by it are probably not suffering as much as India is. Like if you see, even in Asia except for Japan, all others were hardly down. And even in Europe, I think it is down less than a percentage point, whereas in India it's already down nearly 3%. So I think there is some sort of excess in India as I see it, and more so because as far as India is concerned, I think the domestic economy continues to be probably on the path of recovery. So therefore, there are no great domestic worries, but it is just about oil and Europe. I think these are the things that really sort of affecting sentiment internationally, and probably there is some FII selling today, so that is sort of exaggerated a bit by other domestic selling, I suppose.
Well, we've broken below 27,000 now, just a few points below that at 26,999 on the Sensex. That's an 850-point cut. We're just adding to the losses every minute as we go into the last 15 minutes of trade.
Indeed, Menaka. The point was that 8180 to 8200 was the support zone for the market. It tested that 3 times. If you see the intraday chart of the Nifty, it tested it 3 times. And then at lunch, we made the point that it's not the worst case outcome for the market yet. The worst case outcome would be if 8180 breaks. 8180 broke and the market had immediate stop losses getting triggered, panic fall and margin calls getting triggered, and the Nifty at 8130. And I won't be surprised if over the next few days the market has to go back to the previous low of 7960, which is where the market had bounced back from. It's almost playing out as per the script.
Robert, I mean, we're trying to sort of gauge how foreign investors, which have been the big drivers of the Indian markets, will react to this softness in equities across the world. We've seen the US 10-year yield now drop below 2% to 1.9% in safe haven buying. Do you expect that foreign investors will stick to things like like US Treasuries as opposed to come back to emerging equity markets in 2015, at least in the early part? Or do you think that this drop in Indian equities will in fact prompt further buying?
Well, I think the key point or the key question to ask is this the start of a major bear market lasting for, let's say, 3 to 6 months? And I would define a major bear market as, let's say, a market reversal of 15 to 20%. Or is this a short-term nasty correction? And a nasty correction could be a 5 to 10% move. And I would actually say this is a short-term, nasty beginning of the year correction. And I think as we go into late January, early February, there is a high probability that, not exactly at today's levels, but perhaps 3 to 4% lower than where we are today, that we'll actually see a market base being formed. And I think just a number of themes. Theme 1, coming back to what I was saying earlier on, the fall in the oil price is without a doubt very positive for the global economy. Mm-hmm. Okay, it's bad news for economies like Russia, the Middle East and Venezuela, but for the big manufacturing and consuming economies, this is a strong positive. I think the second theme is that, having said that, I think that we're in overshoot territory in the energy markets, and I would be very surprised if, for example, Brent as a benchmark goes well below $50 per barrel and stays there, and I would assume some move back towards $60 a barrel as we go into the second quarter of this year. I think the third theme is obviously that bond yields, and most notably government bond yields, and you mentioned the 10-year US Treasury just below 2% as we talk, but let's not forget that 10-year Germany is now below 50 basis points, 10-year Japan is below 30 basis points. A number of markets have 2- and 5-year yields, which are now in negative territory. So, you know, the comment there is that, you know, the return on investing in government bonds is very unattractive. And I think we also have to recognize that with a low inflation outlook, any tightening by the Federal Reserve is going to be very slow and very moderate. So, yes, we're going through, I think justifiably, a quite vicious market correction, but I think that over the coming weeks that will form a base and it will be a correction rather than the start of a bear market.
Okay, by the way, the Sensex is now down 900 points below the 27,000 mark, so it will be interesting to see. It will be interesting to pull out when was the last time we had a 1,000-point intraday fall on the Sensex.
I'll tell you when the last big fall in the Nifty, according to Nigel, was 16th August when it was down 234 points, and we've beaten that.
Yeah, we've beaten that, but that, even if you extrapolate that, even that won't be 1,000-point Sensex fall.
No.
So clearly 900-point Sensex fall. So we'll just find out when was the last time we had such a fall.
And we're very close to the 8,100 level on the
We are very close to the 8,100 level. Menika, 8,100 is honestly not as relevant as, say, 8,200 was.
Okay.
Because, you know, as the intraday graph would also tell you, 8,200, you tried to take support 3 or 4 times, but that didn't happen. These are the biggest falls that we have seen, but today's fall is actually bigger than that. So we need to go back further in history to dig out that date in which on which we fell more than that. But Mr. Bhat,
percentage terms, those may have been bigger falls.
Percentage terms, those could have been bigger. So that point is taken. But Mr. Bhat, a word on a stock like ONGC now. That's the one which is puzzling a lot of people now. How should we approach it? Because when the first level of crude fall happened, it was all about lower subsidy. But now we don't have clarity on subsidy, and realizations are going for a toss.
Well, I would agree with you, but specific stocks is something that I would like to avoid commenting.
Okay, so oil and gas in general as a sector, how would you approach that?
Well, I think oil and gas, this is the best of times as far as complete deregulation is concerned. I think the government should use this opportunity to go ahead and come out with a policy on subsidy, so that even when if the oil prices go up, I think that particular regime can be put in place where it's sort of market linked, and the maximum sort of subsidy that could be given by the government is sort of capped. That would help in the fifth in the long term. But I think that is what the lesson that we have to take from this as far as the government is concerned.
Robert, what would you sort of start investing in Indian equities, given some of the price declines that we've seen, let's say in the last few days, or specifically today, sectors, stocks that might interest you, areas, spaces?
Well, the obvious theme is, number one, exporters, reflecting this slight sell-off that we've seen in the Indian rupee. And I would argue that the competitiveness of the Indian rupee today is good relative to a number of other currencies. I think, secondly, obviously, energy consumers. Their input costs have come down quite sharply indeed. And then thirdly, given my positive outlook on Indian inflation and the likelihood that the trend in Indian bond yields and Indian interest rates is down, therefore investing in sectors and companies which are sensitive positively to lower interest rates and a lower inflation environment. Those are the sectors that you want to focus on. And I think one point to make is that whereas in our conversations last year, really for the most of last year, we were concerned about the elevated level of Indian inflation, I would emphasize that is very much on a downtrend now.
All right, fair enough. Mr. Bhat, the same question would apply to you. You've already responded to a question on oil and gas. What sectors look attractive to you given the kind of declines we've seen specifically across, financial stocks, for instance, today?
Well, I think the excesses that we have seen in the downfall in the market today, I think should be used as a buying opportunity, at least for long-term investors, especially the cyclicals. I mean, the auto companies seem to be a good bet today with the sort of fall. And even, I think, banks, both private and public, because public sector banks, I think the government has come out with the blueprint on how they're going to run these banks with probably a lot more of autonomy. And they've also said that they would be prepared to pump in that required capital. I think these are all sort of good things. I think so. Financial services sector, auto companies, and probably even engineering companies, because I think with all the sort of ordinances that have been coming through thick and thin, I think there will be some sort of an impact on all these stall projects, and probably even the CMI data suggests that new sort of investments are being thought of by entrepreneurs. So I think all these things augur well for the Indian economy. So therefore, the economists in the two cyclicals are the ones I think to go ahead with.
Would you invest now, or would you wait for some more of this correction to play out, Mr. Bhat?
I don't think you can ever call the bottom of the market very well. So therefore, I think you should start nibbling right away.
Okay, so you're clearly of the view that, Robert, is that this is maybe a sharp and nasty correction and not the beginning of any kind of trend downwards.
I don't think this would last very long because, as I said, the Indian economy seems to be on the path of recovery, and whatever happens, I mean, unless there is a crisis in Europe where Greece goes out of the euro or something like that, unless that happens, I think these things will sort of moderate over the next few days.
Robert, then a final question to you. I know you've put the possibility of a Grexit, as they're calling it, at low at this point in time. The next big trigger for European markets specifically will be bond buying programs by the ECB. How crucial will be the structure and the size of that bond buying program for markets to have conviction that that could be a potential sort of move against deflation, or an effective move against deflation?
I think two answers to that question. The first answer is that it is European Central Bank policy to increase the size of their balance sheet from 2 trillion euros to 3 trillion euros. They have so far been intervening, buying asset-backed securities, covered bonds, and bank loans. But, it is statistical fact that they cannot increase their balance sheet to 3 trillion euros unless they do quantitative easing by buying government bonds. So I think the high probability is that they will come in, and probably in February, as a buyer of government bonds to get that balance sheet back up to 3 trillion euros. Now, I think that will be a factor in driving the euro lower, and I think there's a very high probability that we will see further declines in the euro. That is positive for European exports. It is also positive for reducing deflationary forces in Europe. So to that extent, I think that that will reduce the risk of a sustained recession in Europe. Now, I think the other issue is that whereas we have seen positive structural change in economies like Portugal, Spain and Ireland, there is still a lot of structural change required in countries like France and Italy, and clearly, we have this political problem in Greece. So, Europe is not out of the woods by any measure, and I think one can be critical of European leadership in not carrying out sufficient structural reform, and frankly, I think we also need some fiscal relaxation. Monetary policy can't act just on its own.
Okay, so, sorry, now this is the final question. Then if you are, expecting some ECB action in February, will that in a correlation term put a floor to this short, sharp correction that you're expecting in global equities?
I think it will. I think a number of factors. First factor is I think that European Central Bank quantitative easing would be supportive for markets. I think furthermore, this fall in the oil price leading to stronger economic data out of Asia, including India, will be a positive. I also think that the data that we're getting out of the United States will probably hold at a growth level between 3 and 3.5%. I don't think we can make a 5% growth out of the States, but if we get 3 to 3.5%, that is generally a positive growth outlook. So a combination of good growth data plus ECB action, plus let's not forget that People's Bank of China and Bank of Japan are also carrying out their own monetary easing programs. So, all of that, I think, will put a floor under this market and turn around, what is obviously super negative sentiment as we talk.
All right, Robert Parker, you are Bhat. Thank you very much for joining us with that perspective on global equities and Indian equities. We'll now get to stock-specific conversation with Ajay Bagga, Devang Mehta, and Kunal Sarogi. Having introduced them, I'll go to Krashan.
Sorry. I just wanted to make one point. Up until last Friday, the top gainers in the broader market were all stocks with poor balance sheet, and the call was that this year all these stocks will do well. And if you see today, by now, all these stocks are now the biggest losers of this month.
All the stocks that could have benefited from a low interest rate because they could have got rid of
the high beta trade which was playing out in the first 3 or 4 days, that's reversed in the last couple of days.
All right, fair enough. Now let's put some stock-specific questions to Ajay Bagga, Devang Mehta, and Kunal Sarogi. Good afternoon, gentlemen. Ajay, let me put a question to you that Senthil put to our previous guests. Are you a little taken aback by the ferocity of the fall that we've seen today? Or is this a buying opportunity? And if yes, what stocks would you be dipping into?
Yeah, Menika, definitely taken aback by the ferocity and the way markets have fallen even in the last 1 hour or so. So definitely a surprise. We were rather expecting more allocations to come in. And frankly, Greece is not that big an issue, just like Argentina, Turkey last year, which I've been talking about. There is a Venezuelan default which will come by. So we were expecting some minor, issues to come in. Greece, if you look, GDP-wise, it's not big enough to make an impact. In terms of what do they need this year, their financing needs this year are about 24 billion euros, out of which they have an IMF line standing of 7 billion. They have internal accruals. So more than that, they need about 7 to 8 billion euros is what we are talking about. And I really don't think, and what has been coming out even from the utterances of the leftist party, which will probably win these elections, is the Jan 25th election, is that they will be different when they are actually in power, rather than the rhetoric.
Fair enough, Ajay. Maybe Greece is overdone in terms of a concern. How would you respond to what you've seen in the markets in India today in terms of the fall? Is it a buying opportunity? If yes, what looks attractive to you at the prices that we are seeing in the last 5 minutes?
Yeah, what looks attractive stays the same. I would say look at banking. That's the sector that is going to benefit, and out of that, private banks is what we favor. Auto, cement, I think these would be the top 3, and along with that, IT and pharma. These would really
pretty
make
much buy most of the market, right, with the exception of industrials, isn't it, Ajay?
Yeah.
Okay.
So can't talk specific stocks, so it becomes a little difficult.
So buy everything except for industrials. Yeah.
Okay, Devang, hi, good afternoon. What's your sense? Do you think the poison is still not out, and would it be good to actually stay on the sidelines and wait for further correction, or would you deploy some cash now?
Good afternoon, Anuj. Though it's not a very good afternoon for the markets. In fact, we do feel that probably, again, this is in fact a right chance. And we got a lot of calls today from people that why is the market falling? And rather than just getting into it, that why is the market falling, I think now the time is for real action. And in fact, people at around 8,400, 500 wanted to buy this market. So I don't see any reason why you shouldn't nibble out into equities at this point of time. And that too when your index as well as your good mid-cap stocks, some of the good quality mid-cap stocks have also been seeing a good amount of poison in the system today. So probably we feel that it's a little overdone for the Indian markets, though at the expense of being wrong for a couple of days, because you never know when capitulation starts happening across the global markets. India is also integrated, and that is the price we pay. So probably a couple of days there can be a correction of around 100-150 points on the index, but you wouldn't be able to time it. So my take would be, and our take would be, in fact, we should start buying good banking stocks, NBFCs, also a little bit of defensive element in the form of pharma, FMCG, and even IT could be included in your portfolio.
Kunal, when we spoke to you about at the beginning of the show, you said you'll be looking very closely at 8150. 8150 has cracked, and what's the next level? Is it all the way down to 7950, or could we bounce back from here?
Well, I was expecting for a pullback to happen, Senthil, but that clearly hasn't happened today. And what worries me is that we're going to close below 8175. So now that we're closing below 8175, the next port of call for the Nifty, I think, would be close to about 8,000. So I'm expecting another 100 points on the Nifty on the way down. Remember, there will be margin calls also tomorrow because a lot of long positions, especially retail long positions, need to be unwound. So I think overall, I think markets are definitely headed lower. One should not be in a hurry to buy.
All right, gentlemen, stay right there. We're going to get some insight into dealing room chatter with Nimesh Shah. He's here to take us through exactly how dealing rooms are reacting to this big sell-off this afternoon. Nimesh.
Yes, Menka. In fact, the last 1 hour of trade could be clearly said that, there is panic selling now in the market. And once, 8200 got breached, you saw margin calls getting triggered for the retail investors as well. So the last 1 hour of trade was clearly panic selling. Even intraday till 2 o'clock, till the time Europe had not opened, 8200 was a very strong support for the Nifty. The bulls were trying to defend that particular level, but once that got breached, most of the people seems to have thrown in the towel. But if you look at today's trade, it's largely large cap driven. Most of the index stocks are down, in today's trade, and mid caps and small caps though are down, but not still there is not panic selling yet. The next level, I'm told, is that you can see a big capitulation in the mid cap and small cap. Remember, those are the sectors and stocks which have been a huge outperformer in 2014, and even in the last few days, you've seen a relative outperformance of mid cap and small cap. Now the fear is you might see a big capitulation in that space as well over the next few days. So from a Nifty point of view, the next level, even all the technical analysts have been talking about, is 7950. But it looks like maybe from here you might see some bit of support on the Nifty, but the big fear in the dealing room is that you might now see a big crack in the mid cap and small cap, and individual stocks may see further selling in days to come. So net aggressive sell-off in the last 1 hour of trade, especially some margin calls getting triggered. But it looks like from here on, maybe
Nimesh, who's selling? Who's selling? Do we have sense of?
Well, FIs have been, Menka, the FIs have been sellers in the few hours of early morning trade. Post Europe Open, that got further accelerated. The sense I got is, at least in the first half, the support that we got on Nifty was largely DIs driven. One of the large insurance player was actively looking to buy the large cap stocks in the first couple of hours of trade when we saw a gap down. After that, it looks like the DIs have stopped buying, and there is one-way selling coming from the FIs. So that has actually led to a bit of below 8200. There was further pressure on the large caps and mid caps as well. So the sense I'm getting is there is selling from the FIs. Whatever DIs bought in the first half, now they have stopped buying at lower levels, and now the fear is you might see further sell-off in the mid cap and small cap.
Okay, Nimesh, thanks a lot for that. Sudarshan Sukhani also now joins in. Sudarshan, hi, good afternoon. Surprised by this move, or do you think it's par for course? And really, in terms of the market trend now, how should one play this market?
Oh well, good afternoon. I'm very surprised by the move. Of course, by the time we opened up tomorrow morning, the Dow was suggesting that something like this could happen. So I'm surprised when we closed yesterday. Since then, so clearly it took me unawares. But that's the market for you. The trend has changed decisively to the down. Now, whether it's down or choppy, that the markets will tell us. But I don't think it's choppy. It's probably much lower levels below 8,000.
When the trend has changed, is it a short-term trend, medium-term trend that has changed?
Yeah, Senthil, today's big decline has changed both the trend together. It was stupendous. And this is not a bull market fall. It cannot be. Bull market, sometimes bull market declines are arrested by the afternoon. We saw one last week. And this large range, small gap, and then a continuation, all indices, it's something much deeper. Now, the markets will tell us, but the first step is that if you have trading positions still, and you really shouldn't be having them, if you have them, then you must get out.
Okay, Sudarshan, but what about shorting the market? If you believe that the trend has decisively changed, in that case, you can make money both ways. So, at what point would you advise fresh shorts? Because today put option prices would have gone up dramatically. So, how would you approach shorting this market?
No, although I did not, but at some point in the day itself, a short window opened up. But anyway, now the problem is, this market should be sold into. So, absolutely correct. The only problem is one of tactics. Do you sell after a 250-point decline, or do you wait for a rally that may not come? I think the correct approach is to start building some put positions tomorrow. If there's a rally, then you can add to it. But the market has made lower highs, shown its inability to cross 8600, had a very deep fall today. It's not looking good.
Okay, while we're saying that, we must point out, I think there's been a wee bit of a recovery in European markets. If you take a look at how they're faring right now, since we have been pointing to how global markets are doing as one cue for our equities here, I think we've seen a bit of a recovery there. So you can see now, the German DAX is down just 0.1%, the CAC is down about 0.5%, whereas the FTSE continues to be lower by a little over 1% at this point in time. So some markets in Europe are seeing maybe some reduced momentum in selling, so to speak. We'll go back to our guests. Devang, both you and Ajay identified pretty much all the sectors, with the exception of industrials, as sectors to buy into these dips. Let's talk specific stocks, right? Would ICICI Bank, HDFC, stocks that have been beaten down considerably in trade today, continue to look exciting to you, or do you think that this correction, if it continues, will bear most on those two stocks or those financial stocks?
I think what would happen is, in fact, Bank Nifty or rather your banking stocks have in fact been the price point and attraction for the market, and it's been a big savior for the markets in the recent past. So if at all the correction goes on, and if at all the world market collapses and globally there is a catastrophe or something, then probably these stocks would suffer. But having said that, the highest conviction for the Indian markets or for Indian equities is still there, and the consensus trade is to long India this year. So if at all this theme plays, then there can't be any substitutes for the Indian equities, and for that I think banking as well as your NBFC stocks and autos, which are supposed to be high beta, and you carry that risk forward. So these stocks like ICICI, HDFC would be the front runners if at all the market bounces back. And you can't say in a couple of days if the US market and European market start recovering, then Indian market we have seen in the recent past have bounced back very sharply. So this all would be the stocks which we have bought for investment would become your trading stocks and could give you fantastic gains.
All right, we've closed 3% lower on the Nifty, the Sensex and the mid-cap index. So that's been a day
and the biggest percentage fall in the last 2.5 years. So
biggest percentage fall in the last 2.5 years in a single day of trade? Well,
yeah.
okay, there you've got it, a day of records then. The top losing stock on the Nifty, not in terms of weightage, just in terms of percentage decline, has been just Jindal Steel and Power, down 7% in trade today. ONGC right behind that at a 6% cut. Sesa down 5%, Tata Steel down 5%. But it's these 3 or 4 stocks that have hurt the Nifty the most. HDFC down 5%, Reliance down 5%, ICICI Bank down over 4%, Tata Motors down 4%, SBI down 4%. We had a bunch of other PSU banks doing very poorly. PNB down 4.5%. BOB was also much lower in trade today. So I think these were the ones that weighed the most on the Nifty. If I continue with the list of losers, it's going to take me forever. So I'll just wrap up by saying the only stock that persisted in the green despite the late afternoon accentuated sell-off was Hindustan Unilever. That's closing the day with a 2% gain. So considerable amount of buying, support and confidence in HUL today.
Indeed. It had the DB upgrade in the morning plus the overall market scenario. But Menika, the point that I've made through the day, and at the risk of repeating myself, if you see the board, if you see the top 6 contributors to the Nifty losses, they're all from different sector and leader in that particular sector.
So ICICI, HDFC, Reliance, ITC, L&T, TCS.
Indeed. So, so that this is exactly the kind of the day, because this tells you that there's a problem from the institutional side, there's a problem from the FIS side. They would have sold in today's trade, even if the numbers don't corroborate to the extent to which they would have sold. But let's talk about some mid-caps as well, because the advance decline ratio was 1:8, as you would expect on a day like this. None of the top 10 traded stocks, barring GSPL, was in the green. Unitech was down 5.5%, Suzlon 5%, HDIL was down 7%. Even the erstwhile outperformer Ashok Leyland, that was also down about 2% or so. Then we had IFCI down 5%, TV18, the owner and producer of the channel you're watching, that was also down about 5%. So big fall across the board in today's trade. In terms of gainers, GSPL and really bizarre on a day like this, HMT was up 7%.
Yeah, and public sector focus.
And Tilaknagar Industries, a liquor stock, was up 4%. Maybe some,
so that you
some
can drown your losses or your woes in alcohol. So why it would be Tilaknagar that would benefit the most is anybody's guess. But
because that's all you can afford right now.
Ajay, are you buying Tilaknagar, and what would you do tomorrow? What do you expect will take place in these markets tomorrow?
Well, Menika, I think it's overdone, especially given the domestic situation in India, but global linkage is causing this. Probably it continues this way. We'll have to look at global cues, but I would be a buyer and I would suggest buying. I think it's giving a good opportunity. Frankly, the market has retraced back quite a bit from, it's given about 7% returns from last June to now, before today. And you got a 3% cut today. So you're getting it at a good discount. And I would keep on buying selectively in the sectors that I like.
And would your buying be sort of slanted more towards, let's say, some of the large cap safer bets because you think some of this correction might play out more heavily on the mid cap side, or would it be spread across?
See, again, FI selling, we see a lot of impact coming on large caps, what Anuj was also mentioning, because you're frankly trying to get liquidity and you sell whatever you can sell, despite any fundamental views that you might have. So the impact comes more on large caps. Domestics, when they lose hope, that's when you really see mid caps. That's a very generalized statement, but largely ownership, if you look around, that's how it would work out. So I'm for more quality stocks, more durable stocks. So I would go for large caps. That's a little contrarian view, but I think India, as you get it as a macro story, and as it goes ahead, your large caps will catch back, and they have underperformed vis-a-vis the mid caps. You will get the large caps coming back. That's my personal belief.
Okay, so Darshan, your favorite stock, Hindustan Unilever, is 3/4 on the way to your target of 1,000. But in this market scenario, do you think it can hold up, or even it will fall over the next few days or so?
No, nobody knows what. It should fall over the next few days, but it's a very nice stock to own. And unfortunately, the banks have taken a hit. Now, if you are a long-term investor, you have to assume and expect that these corrections are inevitable. So they are as inevitable as death and taxes. So don't worry about it. But for short-term traders, don't go long. It's not there.
Sure. Okay, Nigel has sent the stat that I was looking for. It's the worst single day since 6th July 2009.
Okay. 2009, is it?
75 months. So biggest fall in last 5 years and 5 months. And why that's important is because in 2009, we were still recovering from bear market. This is the biggest fall in the bull market that we've had, the biggest single day fall. Bull market started somewhere in 2013. So from that point of view, it's the biggest fall that we have seen in trading.
You know, Sudarshan, when Anuj put his first question to you in the afternoon, you sounded concerned about how both the short and the medium-term trends have changed. What will tell us when those trends will be restored? What will tell us that this correction has come to an end? Of course, I know that the easiest answer to that is when stocks stop falling. But will it be a sort of a slow peter out to the correction?
Oh, no, I don't think it's this correction is probably going deeper. My point is just what Anuj said. This is not a normal decline. Now, what will tell us that this correction is over? That if prices don't have to stop falling, they have to actually take affirmative action and go above 84.50. The high that we made yesterday, a little below 84.50. They have to go above that. That is what will tell us that the correction is over. I don't think it's going to happen tomorrow.
Ajay, I know it sounds outlandish right now, but what is the risk that we are in early stages of something similar to what happened in 2008? At that point also, it was started with one particular country's problem, but we know how it all, eventually folded out. So, is there a risk, however minute that may be?
A couple of things, Anuj. One, the world is in a monetary easing cycle, and I think the lessons have been learnt by the central bankers, especially the way they have turned around the US economy by huge monetary stimulus. So somebody like Bank of Japan, you are seeing China has announced $1 trillion of fast tracking of nearly 300 infrastructure projects. So there is going to be a lot of concerted action from the central banks, as has been happening in the past few years. So I think 2008-9, there was a lot of first-time issues that were coming for this generation. 1929 people probably had seen a lot of that, but when Bear Stearns went down, we were all saying, okay, one hedge fund has gone down. When a couple of money market funds broke the dollar, we said, okay, let's see what goes on. It was Lehman which really made the Fed sit up, and then you saw concerted efforts from central banks. So I think that's what's really giving a backstop to the global markets, global asset prices. That is the big change from 2008.
And as Robert Parker was pointing out, I think, Anuj, that the fact is that a lot of Greek debt is held by the European Central Bank, rather central bank, not so much by commercial.
So the contagion effect will be
slightly
limited. I don't think this
but
can be compared to 2008.
But
and let's really be honest, this is not the first Greece election we've seen. We've seen the Syriza make similar noises the previous time. Maybe they'll win more this time, but they're not going to.
My only problem with this argument is that everyone is thinking like that. And that is what the VIX is.
Well, I get what you're saying.
Both in the US and in India.
Yeah, but let's not forget that I don't think Greece can act in a completely isolated fashion, given that I don't think the left wants to exit the EU. So,
okay, Kunal, a question to you again. The extent of the fall, how far can this take us? I know you've given us levels a little earlier, but in your opinion, is this a short, sharp correction, or has the trend changed?
Well, definitely, Senthil. I think there's more in store. You could see a bit of a pullback tomorrow in case the Dow holds up and there's no more decline there. I think the markets might open with a gap up. But what remains to be seen is that whether we are able to close above 8175 or even trade above that level. To my mind, that is the most critical level for the Nifty. So if it closes above 8175 tomorrow, then for the time being, I think the correction would get arrested. Otherwise, we're definitely in for some more correction. And 7950, 8000, the level that's being talked about, I think that's the level we're headed.
What would you buy in this market of falling prices, Kunal?
See, I'd be very reluctant to buy Manika, but the first stocks that I'd buy would be banking stocks, and I'd buy them once they start to show some bit of real strength. But I'd wait and watch for now.
Okay, so let me sort of flip that question and say, are there good shorting opportunities? I know you gave us a couple of words, when you spoke to us earlier on the show in terms of last hour trades, but any good shorting opportunities that you see open up between the next week or so?
Well, I think definitely one could short high beta if you're slightly more risk taking, and if you're slightly more risk averse, I think even IT makes for very good shorting positions, is because the structure there have weakened quite significantly. So I would say that one could short even Infosys and Wipro ahead of results. I think those are stocks that might come in for some bit of pressure going forward.
Okay, Kunal, thank you so much. Devang, thank you so much. Ajay, thank you so much. Sudarshan, thank you so much. My gentlemen, thank you for joining us on what's going to go down history as a pretty historic day. Possibly call it a terrible Tuesday or something, but it is going to go down as a day of record-breaking falls.